Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. As usual, I'll be discussing key earnings and economic data for the coming week. Starting with corporate results, we have TUI Travel, United Health Group and Citigroup reporting on Tuesday. Bank of America, Goldman Sachs and Alcoa reporting on Wednesday. And on Thursday, we have Morgan Stanley and American Express both reporting. Moving on to the economic calendar, UK and Eurozone inflation, the Bank of Canada interest rate decision and the Bank of England monetary policy statement, Australian employment and Chinese GDP will be the major events to watch this week. So on the data front, it is a quiet start on Monday with Martin Luther King Day in the US, but we do have Eurozone trade balance. On Tuesday, we have German inflation and UK CPI on Wednesday. We see Eurozone CPI, a busy day on Thursday with Australian employment change, Chinese GDP, US housing starts and jobless claims. And finally on Friday, this will see release of UK retail sales as well as German PPI. So over in the US, earnings season will kick off with stock markets trading at all-time highs, and traders are keen to see whether these lofty valuations are supported. Firstly, the US is currently experiencing one of the most favourable macroeconomic climates for a while, with the economy at its strongest pace in 13 years. Growth is broad-based, interest rates are historically low, Trump is supportive of deregulation and tax reforms could give a boost to US firms. Furthermore, global growth is also on the up, boosting US business. Earnings on the S&P are expected to grow 11.8% in the fourth quarter of 2017, meaning that there is potential for earnings to come in higher than they did in the first quarter of 2017, which was the strongest growth recorded for a while. Added to this, earnings growth is expected across the board, with all 11 sectors forecast to see earnings and revenue growth. This sort of optimism hasn't been seen by markets for over 5 years. Interestingly, there should also be a return to top-line earnings growth. 2011 to 2014 saw gains mainly attributed to cost cutting. This year, however, we expect top-line growth to be boosting earnings at a rate of around 7%. The recent tax reform will also be a key theme, with some numbers muddied by one-off tax charges, but overall companies have given off a generally positive tone towards the expected impact of the reform. UK inflation is expected to remain at elevated levels of 3.1% year on year, and should we see inflation move even higher, then markets could start to raise their bets of another interest rate rise to come. However, the reality is that the Bank of England is unlikely to start hiking rates again soon, given the looming uncertainty over Brexit. Furthermore, high levels of inflation combined with falling wages in real terms could impact consumer spending. The UK economy is heavily reliant on the consumer, so any signs that inflation is advancing could see sterling move briefly higher. Given the relative unlikelihood of a rate rise in the near term, any move higher is expected to be capped. And given the FTSE's inverse trading relationship to the pound, this could result in a sell-off in the index, with multinationals and retailers taking the biggest hit. Retail sales data on Friday will confirm if the UK consumer remains resilient to increasing prices or whether the squeeze on wages is indeed keeping households from spending. The Eurozone is facing very different challenges, firing on all cylinders. Growth is robust and broad-based, but inflation is remaining stubbornly low. Minutes of the December ECB policy meeting released on Thursday painted a very positive picture of the Eurozone economy, which is now considered to be in expansionary territory. However, there was a notable concern from ECB officials regarding inflationary pressure, which was quite different to the tone of the ECB President Draghi back in December, when he seemed more hawkish in his increased confidence in inflation prospects. Low inflation appears to be one of the few factors standing between the ECB and a firmly hawkish stance towards monetary policy. We know from the meeting minutes that the ECB are looking to change their forward guidance sooner rather than later, potentially ending quantitative easing as soon as September this year. However, without a pickup in inflation, any interest rate rise could still be a long way off. Investors will be watching carefully to see if inflation will tick closer towards the ECB's 2% target. Should this be the case, then we could expect fresh legs on the current euro rally, and 1.22 could be the realistic target. On the other hand, a weaker than forecast reading could weigh on sentiment for the euro and see the common currency give back some of its gains. Although given the revelation by the ECB that they will revisit the forward guidance, any losses could be capped. The probability of the Canadian Central Bank hiking interest rates is at 75% as we move towards the meeting conclusion on Wednesday. However, concerns that the US is moving closer to tearing up the North American Free Trade Agreement are making traders rethink the probabilities. Interest rate expectations swung wide across last week as reports resurfaced that President Trump is preparing to tear up the agreement, which he considers bad for American people, and Canadian dollar traders are taking the threat seriously. For the time being, this is offsetting any potential gains from a rate rise. Moving into next week, should the NAFTA story start to evaporate, then we could see the Canadian dollar pick up against the dollar. Thank you very much for watching. If you wish to catch these videos as they're released, please follow LCG on social media.